To many folks, debt is just a dirty four-letter word. But the truth is, debt is a phenomenal way to invest, but even better when you're the debt holder. Today, we sit down with Whitney Elkins Hutton, and she shares how you can be a debt investor, meaning you are holding the paper, you are the bank providing loans to other investors. This is a strategy that is becoming more and more popular, especially given the current economic environment. If you want to learn how to grow and diversify your portfolio, not just with long-term equity apartment investments, but with debt positions as well, check out this conversation right here on Multifamily Insights. Whitney is the Director of Investor Education at PassiveInvesting.com, one of the nation's fastest growing private equity real estate firms with over $1.5 billion in assets under management. Now, she is also the author of Money for Tomorrow, How to Build and Protect Generational Wealth, focusing on helping high income earners turn strong earnings into long-term, stable wealth through a four-part framework designed to reduce volatility and improve decision making. Let's welcome to the show, Whitney Elkins Hutton.
Thank you so much for having me on, John. This is going to be fun.
Yeah, absolutely. Whitney, it's great to get you back on. Obviously, the market environment has shifted a little bit from our previous conversation. But for those folks who are not familiar with you and the work that you do, why don't you take 60 seconds or so and give us a little bit more context?
Yeah. So everything that I do, actively and as an investor myself and professionally, is to help people take their active income and savings and turn it into passive income and long-term wealth. And it's been kind of a wild ride. I mean, I started off with single family rentals, scaled into multifamily properties, active ownership, then eventually into syndicated raises, both actively and passively. And the last 4 years have really been focused on me scaling my portfolio passively, and just kind of the twists and turns of navigating the market environment, and where does equity fit into that, where does debt fit into that, and just I feel like my evolution of as an investor has really kind of taken hold.
So there are a couple things there, right? You talked about really focusing on helping other people learn how to invest passively. You talked about, really just a couple of the key decisions that you've had to, you know, wrestle with yourself and kind of evolve with your strategy. Let's start with just that, right? Active and passive, right? So I know when I was starting to invest, passive investing seemed like a pipe dream, just didn't seem like a realistic goal, right? It was always about, hey, you need to go out, be a landlord, find these deals, figure out how to renovate them, the BRRRR strategy, all these different things. Just talk to us about how you approach active investing, passive investing, and more importantly, like, what are some of the questions and things that our listeners need to be considering to figure out which path is right for them?
hmm Yeah, I think when people stumble across investing in real estate, whether it's in debt or equity, they're trying to fill a hole, which comes down to, like, how do I grow my cash flow and my equity, and maybe take advantage of some tax benefits. And you know, if they bring in their current investment philosophy, which has been probably stocks, bonds, and mutual funds, let's get the highest yield possible. They kind of put themselves in an upside down situation, because I don't feel like, or at least, and I've never really felt this way, but I can see the allure. Chasing yield is what gets investors in trouble. And so if investing in private assets isn't about chasing yield, what is it about? Well, it's about you as the investor understanding your investment philosophy, your thesis, your goals, your risk, your timeline, your risk capacity, uh, you know, crafting a custom portfolio that fulfills your needs, and then going and picking the assets that actually match in that portfolio today, tomorrow, and 10, 15 years from now. And so that's sometimes where people get a little bit overwhelmed. They're like, wait, Whitney, you know, I'm looking at a multifamily deal today. Like, help me analyze it. I'm like, well, does it even belong in your portfolio, or does something else belong in your portfolio? So I think that is the biggest key that I, really help people, build out right now, is that thesis, that understanding, what is it that you need? Because you can listen to all the podcasts, read all the books, follow all the blogs. And if you don't have this built out for yourself, you're going to be borrowing somebody else's investment philosophy. And that investment philosophy is right for them, but is it right for you? And that's what we have to get, really truly aligned, especially in this market, this volatility that we're seeing. Gosh, I've been throwing out the S word for about 6 months, stagflation. We're actually finally starting to see that word materialize in the news. And so it's even more critical now that investors have this lens in front of them.
Whitney, I love what you just said because, it's something that it just gets overlooked. Having your own investing thesis, your own investing philosophy, strategies. I can't tell you how many times, even when I was starting out, like you just start analyzing deals, right? And what's a good deal? And there's a quote I absolutely hate, and it's if you find a good deal, the money will come. And I hate it because what's a good deal? What's a good deal to you may be a terrible deal for me, right? Are you talking just cash flow, cash on cash returns? Are you talking just IRR? Are you talking risk profile? Like all these things matter. And the reason it's so challenging for newer investors is because they have not taken the time to identify what they're solving for. Like what role is real estate playing in your investing portfolio? Is it meant to be more of the aggressive, you know, double down opportunities, right? Are you looking for that? Are you looking for more long term plays? All that matters because if your goal is to quit your job, then you need a more aggressive investing philosophy. If you are already a six figure income or high six figure earner, you may just be looking to diversify or lower your tax obligation. You probably want more conservative investments, right? But without having that clarity, you don't know how to really evaluate deals and recognize where the risk lies in these opportunities. I think the other thing, though, is it changes how you view failure. There's a lot of buzz right now about deals not panning out. One in particular with, Brandon Turner of Bigger Pockets fame, and I think it's very easy for people to look and say, "Oh, every headline I read, by the way, says the same thing. He lost $15 million of investor capital." It's never the team. It's never, "Hey, this investment didn't pan out." And the reason I say that is how you feel about a deal not working out really comes down to your risk tolerance, your process, and where you see opportunities moving forward. That doesn't change the deal itself, but if you are comfortable taking a certain amount of risk, that's part of what you recognize. If you were never comfortable taking risk, you probably shouldn't have been investing in these kind of deals in the first place. So how do you think about that?
My gosh, there's so much to unpack there. Uh, so first of all, there is understanding the risk of the actual investment. And I just want to draw out something here. The reason why, people go on YouTube, they do a search or whatever, and they land on marketing that is how to underwrite a deal, right? Because if I say, hey, let's put together your investment thesis, how many people are going to click on that?
Nobody
That
wants
is
to see that.
not
Right, right.
clickable. Okay, so it unfortunately, um, operators are trying to get eyeballs, right? And a lot of the operators out there do education. A lot of investment groups, education groups like Passive Pockets. I mean, I'm not throwing anybody under the bus, but they're trying to get eyeballs. And they're going to get eyeballs with the most clicks. They're looking at lead magnets. They're going to get the most clicks. And that, creates a confirmation bias, right? Because if I'm looking at passive investments, like how do I get in passive investments? Because if I'm the new investor, I'm going to see like 10, lead magnets on, how to underwrite deals, how to avoid risk, how to avoid failure, right? I'm not going to see the investment thesis. It's going to be incredibly buried. And I'm going to think because there's 10 to 1 that this is what I need to learn. And that's simply not the case. So that's my argument. Like you got to go back to the investment thesis. But how do we orient what's happened in the past few years? Right. Um, from 2000, 2012, whenever, the laws changed under Obama and more, accredited investors had access to these private investments into multifamily, self-storage, mobile home parks, whatever, the whole nine yards. Uh, it was rising tide lifted all boats. I mean, there, uh, the worst operator in the world probably could have made money in that market. Okay, so if all they can actually own and control is their investment thesis and how they underwrite a deal, okay, they cannot control the market. So we come back to, I'm kind of bouncing around, but there's so many through lines here that I want to connect together. We have operators that have been challenged that hit a bad market, didn't, one, you didn't read the tea leaves. There were no tea leaves, by the way, to understand that interest rates were going to rise as quickly as they did. They were making good judgments with the best information they had, but the market changed, the information changed, and they couldn't adjust fast enough in order to save some of these deals. We're still going to experience that fallout. But the investor thought that the operator could own the response to the market, and they can't. That is the one element when it comes to investing in private deals or even in the stock market. Like, fund managers can't own what happens to the market. A fund manager right now, they can't own, like, if Anthropic all of a sudden decides that they're going to halt their AI platform or the growth of their AI platform for right now. And that would have heavy impacts on that particular stock. So we have to, as investors, as private investors, that investment thesis is our guideline. It helps us understand, hey, this is what matters to me. Is it capital preservation, cash flow, equity growth, tax benefits, diversification? These are the risks that I'm willing to take, risks not willing to take. This is what I admit I control in my portfolio, and this is what I know that I can't control. And if I can't control, I need to ask questions to see how well it's being risk mitigated by the operator. Or I just need to acknowledge, hey, I can't go into that investment. And that's the hardest thing for people to understand is, hey, there are just sometimes I just need to sit on the sideline. I stopped investing largely in multifamily deals in 2019. I saw all these multifamily deals go by. I think I did 2 multifamily deals in 6 years personally. And it was just like, I saw the exposure in my portfolio. I was like, wow, I am so overweighted in multifamily real estate. If something materially changes in the environment, I'm hosed. So, but that was painful. That was painful. Like you said, John, like, I'm watching people that are underwriting deals and like, Whitney, come in here. And I'm like, I'm going back to my thesis. My thesis says I'm overweighted. I need to focus over here in debt funds and income producing assets and push pause. I'm not a genius. It just happened to line up for me, and it's not to say that I'm personally not immune either. The 2 deals that I went into in that environment did get challenged. So there's, I think, to put a pretty bow on it, even when we're putting together this investor thesis, the investor has to understand there are going to be elements of private investing or any investing that are just going to be outside your control, period.
Whitney, what I love about what you said is really, I think most of the time we think about passive investing, we think about handing control over to the operator. And what you're really getting at is that you actually maintain control as a passive investor by having a clear investing thesis. If you understand what you're looking for, what role these investments are meant to play in your portfolio, then you are selecting which operators, which opportunities you pursue because you know how it fits to the overall theme of what you're trying to accomplish. I think what happens too oftentimes is people just find somebody they like, I love this video, or you like John's voice, or we like Whitney's smile, and they invest with us, but they haven't really taken the time to say, okay, hey, here's what this investment does. And that's where the power and the control comes in, is being really clear on what you're looking for, understanding what your non-negotiables are. Like, when do you walk away from a deal? What's a green light for you? You've got to have that clarity, and it makes it so much easier for you to invest. It doesn't mean that every deal's going to pencil or every deal's not going to work, but it does make it easier to find opportunities that you can get excited about. I know for me, we did a deal earlier this year. And I don't even, it was just for myself, but I didn't even fully underwrite the deal because I looked at the top line numbers. I looked at, my non-negotiables. It passed all those things. And I said, you know what? This is the best thing I've seen all year, or at least in the last 12 months. I don't need to find a reason to say no if I know that my floor is high enough. So we went ahead and we moved forward. And I mean, you have due diligence for that reason. We went to due diligence. We ended up buying the asset. And again, you can move with more speed when you're really clear of what you are looking for and what you're not looking for. And you can focus that energy and time on the things that matter. Winnie, I want to come back to something else you talked about, right? You said this a couple times, but you talk about equity and debt. And for years, a long time, most multifamily investors only thought about equity. That was the reason you were investing is for equity. We want long-term appreciation, right? Cash flow's a part of it. Yeah, yeah, the cash flow, but the equity, right? You want to get rich, you want to build wealth, and that comes from equity and ownership of these assets. We're seeing a little bit of a pivot now where folks are recognizing the importance of cash flow and debt opportunities are becoming more and more popular. Talk to us about the way you all look at equity versus debt opportunities.
Well, so I want to actually kind of take that a little bit further. I think people expected they weren't just looking at a equity deal going, "Oh, hey, equity." They were looking at that deal going, "Oh, wow, this deal is invested in real estate, which is a hard asset, so it's going to preserve my capital, right? It's going to provide me some sort of cash flow. And I'm going to get equity and I'm going to get tax benefits. So I can get all these wealth pillars in one deal. Okay. And we get some, we can take, advantage of wealth growth through the use of leverage. I got somebody else operating the
Yeah.
asset, right? So I get time leverage there. Now that is a good strategy if the market is recovering and expanding. When it starts, and again, remember, we can't control the market. So when it starts hitting hyper supply and going into contraction phase, that kind of goes away, right? The first thing to get compressed in those markets is going to be the cash flow. And then if the asset cannot withstand the reduction in cash flow, if the reserves get depleted, then the equity gets compressed. And if the reserves are gone, the equity is so compressed, the operator can't ride out the bottom of the market and get to the next growth cycle. You're selling in a down market. There went your equity growth, right? So how do we combat that? Well, as a passive investor, one of the ways I can combat that is to have assets perform in different phases of the market cycle. And some of them will perform in all phases, just, to different degrees. But I want to have like a compilation of assets that perform in different phases of the market cycle. I don't know if anybody's a follower of Ray Dalio. I mean, he has this all weather portfolio. Uh, this is stocks, bonds, commodity, heavy metals. And he was like, only 60% of my portfolio is really performing at any point in time, right? It's not about hitting 100% of my deals performing all the time. That's not the game. It's, how do we get majority to perform majority of the time? And so that's where I, took a hard look personally. We're hitting a hypersupply into this recessionary environment. I'm looking at, okay, where's the opportunity as an investor? Banks have stopped lending. Okay. So, okay, well, great. As a passive investor, that's the opportunity I get to solve in this environment. How do I now, how can I take advantage of this? Well, I can originate my own note to a borrower. I can go into a fund of notes. I can maybe even level up my game and maybe get into, larger, BDC type loans, private credit loans. But then I'm like, wait, risk still shows up. It just shows up in a different way. And guess what? When the market is compressed and going into recession, I want cash flow then. I don't want to take any more risk, right? Rule number one of investing, Warren Buffett's rule number one, don't lose money. Rule number two, see rule number one. So I'm like, okay, in this part of the market cycle, I already have equity assets that need to be able to ride out this part of the cycle. Okay. There are probably going to be some losers. There always will. Your portfolio will get trimmed in that part of the market cycle. Every single time we hit a recession, it's not a matter of if you, as a passive investor, you're going to, or even a stocks, bonds, and mutual fund investor, it's not a matter of if you're going to have an investment hit a challenge. It's just a matter of when and which one is it going to be. So I look at debt as that ability to shore up my portfolio and give me optionality, help me create patience. Okay. We used it as a strategy, a company wide strategy as well, to like shore up our business and, keep our investors earning capital, you know, uh, that way they could be more patient while they waited for their next equity deal. And so, but again, I want to make sure I go into debt investment that is going to be, preserve my capital as well as it possibly can. I want to keep it flexible. All right. And we can go into, how do we underwrite? How do we look at, debt deals? But the biggest thing when you go into a debt deal, especially a debt fund, is that you don't want to be chasing yield. And how do funds create yield? Okay. They either take on riskier assets, okay, or they take your money to the bank to go get more money to then lend out. And are you now a debt investor? No, no. You might now be in second position on the debt, or maybe you got moved to an equity investor on a debt deal. Yes, it happens. It happens all the time. When debt funds take on leverage, this happens all the time. Another exposure here, another way risk really shows up is that when debt funds raise capital and inject it into their own deal. Now, if they disclose that, that is not wrong, right? If it's in the PPM, it is not wrong. That's their business plan. That's what they meant to do. But that creates another exposure to you if you're already an equity holder in an asset that then the debt fund took the money and then lent out on that asset. So now you're dual exposed to the same asset. So we've seen in the space a lot of um, loans that one, funds that are levered, two that are self-dealing that aren't really disclosing publicly the full business plan to their investors. Well, it might be in their PPM. Their, the offering materials doesn't paints a much different story
Yeah.
there. And then, what is the profile of the fund? Is it core stabilized? Is it just a little bit of value add, or are we talking more development deals? Because all of those, again, risk shows up in different ways.
There's a lot there, Whitney, especially for those who maybe aren't as familiar. So I'll break down some of it, right? You talked about, first of all, when it comes to the current environment, you want to take some risk off the table. Debt funds are a way to focus more on cash flow. So that's one of the most intriguing components of debt funds in today's environment. But every debt fund is not made equally, right? So when you talk about that, you're talking about looking at preservation of capital, looking at the flexibility to be able to pull your money out of those funds. How are those funds being deployed? Is it really funds that are being used to go take on more leverage and get a bank loan to invest in other deals where now you're really in a secondary position? Or is it truly being in first position for these assets? What are, for someone who's intrigued by this conversation and saying, hey, I'm interested in investing in a debt fund, walk them through like maybe some of the key questions they should be asking of themselves or of that debt fund manager so they can decide whether or not this fund is the right vehicle for them.
Absolutely. So again, starting back at your investor thesis, we'll get tactical here, right? As opposed to theoretical. Simply, as part of your investment thesis, you should look at all the past deals that you've done, figure out where your weighting is. Are you 95% allocated into equities, be it public or private equities, and then maybe you have like 4%, set aside in cash and reserves? Well, you're missing a layer, that insulation layer, that cash flow layer. So analyze your portfolio. I always look to have a solid breakdown of, emergency reserves, then an income layer. Okay, for me, I take on a pretty hefty income layer. It will tick down as a percentage of my portfolio over time, but I wanted to replace a certain amount of, regular income with my income layer. And then everything past that goes to my equity layer. Okay, once I understand how I want my portfolio to break down, now I can start underwriting to those deals. Okay, how much risk do I want to take in that income layer? And I wanted to let everybody know It's not, the conversation isn't debt versus equity. It's, it should always be an and, right? We want to make sure that our portfolio is crafted as such that it's going to allow us to navigate all different parts of the environment, the market environment. So when I look at a debt fund, what I am actually doing is first understanding what position am I taking in the fund? Am I taking a first position or a second position loan, maybe an unsecured business loan or a third position? As part of this position, I'm also evaluating if there's leverage right off the bat, right? Because the fund can say, hey, I'm a first position lien fund, but if they take on leverage, I'm no longer first position lien. I'm behind a bank.
And Whitney,
Right?
for those who are not as familiar, explain exactly what first position and second position means.
Yeah. Okay. So, you buy your house. Most people could probably like relate to this. You buy your primary house. You go get a mortgage from Wells Fargo or your local bank. And then maybe a few years you've built up some equity. Then you go get a home equity line of credit or maybe a home equity loan to be able to use the equity in your property. The bank, whoever originated that mortgage, is first position lien. They're your largest investor and they're most protective. Low risk, low reward, right? If you stop making payments, guess what they get to do? They get to foreclose on your property and they get to take it back. You see how long you get to live in your house if you stop making your house payments. Okay. Now, if you that home equity line of credit or that home equity loan, that's second position. They are behind the bank. They're still in debt, but if you stop making your payment to your home equity line of credit, they don't get to foreclose nearly as fast. Okay. They have to go through a big old process. If you're still paying your primary, but not your second loan, it becomes a little muddled, as far as like, when does that second lien holder get made whole? Okay. Usually they can force the sale of the property. And that's if there's money left over after paying the first bank note, then they get made whole. Okay. So that first position means you got you know, a lot of leverage there if the borrower stops making payments. All right. So, but if the operator, if they're putting all the first position loans in their fund, but they took all that money to the bank and said, hey, look, we have a $50 million fund. We want to take 50% leverage. So give us another line of credit as $25 million so we can make more loans, so we can give a higher return to our investors. Okay, you're now behind the bank. You're no longer in first position. So the fund is now levered. Okay. So that's probably the biggest mistake that I see a lot of, debt investors make. You know, again, this position is supposed to help us preserve capital, create flexibility. It's not meant to swing for the fences and replace an equity-like return. That's not the intent of it. Okay. So, we can't have that lens in place. The second thing that I look at is, what is the fund lending on? If it's lending on a single family property that's, say, like fix and flip property where, anybody in the United States can buy that house versus ground up hotel construction or ground up multifamily building construction, which your buyer base becomes extremely narrow. And the timelines are all different. There's so many different risk factors between those two business plans of that asset. Uh, you know, that is another thing that I look at. I like, from a conservative standpoint, funds that either 100% single family fix and flip real estate or majority single family fix and flip real estate. But taking care to look at what the other assets that are being lent on. This gets back to the conversation that you and I were having before the show. A lot of people think about, okay, private debt equals private credit. Yes, it is a subset of the private credit space. But what we're seeing in the news, all these headlines that private credit is being challenged and BlackRock and Blue Owl, like their funds are collapsing. They're lending on business loans that have a duration, okay, and evaluation risk. All right. So that kind of brings me to point number 3. of looking at a debt funds, you want to look at funds that have strong valuations, meaning the asset has a known valuation. You're not waiting for that valuation for 3 or 5 years, right? The single family house, that valuation, that appraisal that you just got is probably good for 6 to 12 months, right? There's a shorter valuation window. We know what it's going to be. Also, the loan on to fix up a single family property is probably going to be 6 to 9 months. So I'm pretty sure in the valuation, and I'm pretty sure in the loan duration, those things match. But when I start getting into lending on ground up construction on a hotel or a multifamily building, my timeline now expands to 24 months, right? And is the valuation, is that building $50 million? It might be $50 million today, but will it be $50 million in 24 months? I would like to think the valuation is going to go up, but it might not. Like, if we're heading into volatile environments, I don't have a crystal ball that far out. And let's be honest, most of those construction deals actually aren't 24 months. They get extended out to 36 months. We're 4 years late, past a horrible fire here in Boulder, and like the hotel that burned down, like right on the south side of town, is just now being
Yeah.
rebuilt. Those investors have been waiting for 4 years to be made whole.
And
So
Whitney, I think the thing too, you're just bringing everything full circle. It goes also back to the your investing thesis, because if the intent of this strategy is to provide cash flow and maybe balance those equity plays, then it may not make as much sense to invest in long-term development deals, because they're really the same. You just don't have the equity, right? You're just the debt side of that same time frame, as opposed to single family fix and flips, where those should be, relatively shorter windows, 6 months, 12 months, whatever it is. That should be something that is a little bit tighter, a little bit easier. And you talk about the valuation again. If you ask any of us, what we thought 3, 4 years ago versus today is probably not the same, right? No matter how conservative you are, the environment has shifted and changed so drastically, with things that none of us could have controlled, that it's hard to make those predictions that far into the future. So, just really good thoughts on how to approach it. If you are looking at this, I think focusing on cash flow, looking at the debt side of things. And it's even, sometimes people hear debt and they, maybe the Dave Ramsey's of the world, debt is bad. What we're talking about is being the bank. We're talking about being
Mhm.
the lender and being a part of the team that is lending the money, where you have the leverage from a debt standpoint. So there's a lot of positive in that. So that approach, I think, certainly has a lot of value, particularly in an environment where investors are struggling or don't have as many options to get the financing that they need to do those deals. So that kind of creates an environment where you maybe have a little bit more leverage and you can add more value in helping those individuals do the things that they're looking to do. Lots of great stuff there. Whitney, for folks who want to learn more about the equity side, the debt side, apartment investing, and everything else you've got going on, what's the best way for them to reach out?
Absolutely. Yes. You can reach out to me at passiveinvestingwithwhitney.com. And there you can hop on a one-on-one call with me. We can decide, take a look at your portfolio and understand, like, does it make sense to add in a debt right now, or, equity at this point in the environment? We can connect you with some of our deals. Also, more importantly, we can continue the education conversation because, we just talked about, does debt belong in your portfolio? But now you got to underwrite it. So we have to learn how to underwrite the people, the processes, and the protections. And I have some great materials on our YouTube page to help people with that.
I love it. We'll make sure we link to that in the show notes. Right now, we're going to transition to our round of insights. When you think you found a great deal, asking the right questions could be the difference in finding a stud or a dud. Listen, we've put together a new guide to help you out. It's called 7 Questions You Must Ask Before Investing in Apartments. Now, in this guide, you're going to learn how to uncover red flags, quickly identify underwriting risk, vet sponsors and team members, and confirm key assumptions. Now, this is a guide that's going to help you be a better investor, whether you're an active investor or you're a passive investor looking to partner with other operators. Asking better questions is the key to identifying great opportunities. So download this free guide. Go to our website, casmoncapital.com/7 questions. That's the number 7 questions. And you can access this free guide today. To make it easy on you, though, we've put a link in our show notes. So you go to the show notes, you can click that link and access the guide right now. This guide's going to help you make better investment choices, asking the right questions to build your portfolio. So be sure to download it today. Whitney, give me a failure or an apparent failure that set you up for later success.
Oh my gosh, how much time do we have? I think, it may be the same one that I said before. I think one of my first forays into investing in debt was an unsecured blind pool debt fund. This is like almost 12 years ago. And the first few years actually went really great. This is where I started developing my own thesis around debt. Long story short, chased yield, didn't work out, fund collapsed. And I had to actually go to my husband. I remember the Saturday morning when I got the email and I'm like, oh my gosh. I was like, yeah, so we got 3/4 of our money out of the fund. We had been made whole with the returns, but I had to tell him that the balance of the capital wasn't coming back. Fortunately for us, it was a pretty small amount, compared to our net worth. But that was the scariest conversation to have. It was so I didn't like having it, and the lesson that came out of there. And my husband is an amazing man, and he just goes, "What did you learn?" I was like, so much, so much. And so when we have these failures, it becomes, you can respond as a victim, or you can, we're all victimized, or like you can learn how not to be victimized again.
I love it. Great feedback there. Give me a digital or mobile resource you recommend for our listeners.
We're all talking about AI right now. I would say, Claude has, been a good resource for me. So that's kind of my digital go-to resource right now. Also, getting out of the whole fear-driven news, cycle, Apple News, whatever news, you follow. There's 2 apps out there, one called Feed, Feed, and then another one called Particle. And they really take all the biases out of the news. You just get to see like what's happening and not like the whole spin that's happening.
I love it. Give me the book you've recommended or gifted the most in the last year.
The One Thing is my kind of go-to book. Outside of my own, I do get my own quite often, Money for Tomorrow, but The One Thing, that's probably the biggest one, because it can help people with prioritization, time management, balancing life, what does balance really truly mean at this point in time. So that's still my go-to book.
What's a daily habit that helps you stay focused on your goals?
Putting it on my own oxygen mask first thing in the morning. And then that means I'm looking at what do I need to do for my personal well-being, my health, looking at my own goals, I call it my time blocking 411 session. I get all those done first, then I open up my email.
Love it. All right, give us your number one insight for investing passively.
Putting together that investment thesis, I think it's just pivotal to transform somebody's investing experience. Maybe it gives you more clarity to be able to, put together a truly kind of all-weather portfolio allocation strategy. And when I say all-weather, I mean, of course, amongst like private equity investments or private credit investments. But 2, it just, you're putting a stake in the sand with a cool head. And so when you are looking at that deal, the first thing you're going to do is take that deal and compare it to your thesis. And then, you get to break your own rules, but at least you know why.
I love it. Well, let's go in a different direction. You're out there in Boulder, Colorado. Give us your favorite place to grab a bite to eat.
Oh, gosh. Favorite place. There's so many out here. I'm a breakfast person. I'd rather go out for breakfast. So Walnut Cafe. That's a good local hotspot.
I love it. Walnut Cafe it is. Well, Whitney gives a lot of great stuff. I love your point on just having that clear investor thesis. That's going to make it so much easier to both identify the right opportunities for you, evaluate those deals, the operators, but also manage your own risk tolerance, right? Understanding like, hey, you know that not every single deal you make or you invest in is going to work great. Some are not going to go as well. That's okay, but it doesn't change your investing philosophy. And I can't tell you how many people right now are, screaming from the mountaintops about multifamily syndication, and they're taking their victory laps on operators out there, and they're missing the big picture. The big picture is it's still a great vehicle to build long-term wealth. The season has shifted for sure, but that doesn't mean there's anything wrong with that investing vehicle. You just have to make sure you understand what your investing goals are, your investing philosophy, and your time frame to accomplish that. You also talk a lot about debt funds, right? And it's something that folks should definitely read and look into more. If you are interested in learning more, check out her website, passiveinvestingwithwhitney.com. We will link to that in the show notes. Whitney, thanks again for being a great guest and coming on Multifamily Insights. We look forward to staying in touch with you, and I hope you have a great day.